Good afternoon and welcome. My name is Sarah Blackwell, and I'm one of the auditors on the Real Property and Negotiated, or RPN team here in the Bureau of Contracts at OSC. And I am here to give you just a quick rundown of what you can expect to see here today for the RPN team presentation regarding best practices when submitting lease transactions to OSC for audit. So our approach for this year's discussion is loosely based on a Q&A format, and what I mean by that is that we formulated our presentation based on questions and topics that you, representatives from the agencies, sent to us through a survey that was emailed out in early July. So in a sense, this is really your presentation because these are the things you wanted to know more about. And since switching to an environment that is nearly entirely electronic, there have been some changes and updates to how we receive transactions and what we look for when auditing material that comes in for really all of our transactions, not just leases. However, since the majority of your questions and topics of interest centered around leases, and since they are the bulk of what our team gets to audit, we put together this slideshow to hopefully answer all the things that were touched on in the survey. Now, for some of you, this information will be brand new, and for others, it'll hopefully serve as at least a nice refresher. So let's get started. Today, you'll be hearing from our presenters, Shelby Foster, Nicole McGuire, and Andrea Fabosi, all of whom are also auditors for RPN. And our moderators today are Lindsay Carswell, another RPN auditor and supervisor, and our team leader, Jacqueline Roberts, both of whom will be answering any questions you may have submitted during the presentation using that chat feature we just discussed previously at the end of the presentation. So this is just a quick agenda of some of the topics we're going to cover. The presenters are going to touch on requirements for new leases and amendments, funds reservation or encumbrance for those of us who have been here for quite some time, the importance of the cover letter and what goes into it, money matters with the cost breakdown, the new novation agreement, which as you can see there was formerly known as assignment agreements, purchase orders and when it's appropriate to use them, cost and site justifications, transaction value versus intrinsic value, and why knowing or determining intrinsic value is important on our end, what to do when the value of a contract changes over time, and how to close out a contract. Now, as I said, some of this information will be new, some of it will not, but all of it is valuable. And knowing this information will hopefully help you to be able to understand why we ask for certain information, specific documents, or other material during the course of our audits. And the idea is that providing all this information to you now, there can be less time spent on our end trying to obtain missing information or materials, and more time spent focusing on working through our audits efficiently in order to get them back to you approved, which is everyone's goal at the end of the day. So thank you all again for joining us this afternoon. And with that, I'll hand it over to Shelby, who will guide you through the thrilling world of required lease documentation. Hold on to your seats. Take it away, Shelby.
Thank you, Sarah. Hello, I'm Shelby, and I'm an auditor on the RPN team from OSC's Bureau of Contracts. I'm hopefully going to answer a couple of common questions regarding document requirements and funds reservation regarding lease transactions. The first question we have is, what documents should be included with a new lease transaction? The documents to include in a new lease transaction submission to OSC are a cover letter, which Nicole will talk more in depth about later in the presentation, the STS, or the AC340S. This is a summary of the transaction details, such as transaction amount, contract number, vendor name, etc. An STS is produced in SFS, which stands for Statewide Financial System, upon entering a contract transaction. An AC340S is very similar to an STS. This form is used by agencies who bulk load transactions into SFS or do not enter their transactions directly into SFS. An STS or AC340S is only required for all paper submitted transactions. The next document would be a contract document. This is the written lease agreement signed by all parties. Next, you'll need your justifications. This will be the need, cost, and site justification. Your cost breakdown. A cost breakdown differs from cost justification in that the breakdown is the calculation of how the transaction value was determined. And the cost justification includes documentation to show the cost of the lease is fair and reasonable. Vendor responsibility documents. You'll need your vendor profile, the questionnaire, if it's a hard copy, your workers' compensation certificate, disability certificates, and in some situations, you'll need an exemption certificate. Your B1184 budget approval. What documents should be included with amendments? A lease modification is one term that falls under the amendment umbrella. There are two categories OSC puts lease modifications in: formal and informal. For an informal modification, the items to include in your submission to OSC differ from what would be required for a formal modification. One example of an informal modification would be a reallocation of space, which is where there are multiple agencies renting space in the same building, and for specific reasons, one agency needs to add or reduce their rental space. In the case of space reallocation, OSC would require a cover letter explaining what the transaction is doing and how much space is being added or reduced, as well as a cost breakdown to show the modified rent costs associated with the modified rentable space. A formal modification is when there are language changes to the approved lease. Adding renewal language to a lease, updating Appendix A language, and adding or reducing funds to the contract maximum amount are a few examples OSC might see for a formal modification of a lease. For formal modifications to a lease, some additional documents are required to go with the cover letter. Additional documents needed for a formal modification would be the amendment document, signed by all parties, including evidence of AG approval, a cost breakdown if you're adding or reducing funds, and any additional documents to support the changes being made to the contract. Another type of transaction under the amendment umbrella is a holdover. A holdover is when the lease term has expired and the agency may be negotiating renewal terms with the landlord, or even a whole new lease, possibly even at a different location. The agency still has the need for the currently occupied space, so the agency will exercise the holdover option to continue tenancy, usually on a month-to-month basis. Holdover terms are typically stated in the original lease agreement. Items to include in a holdover transaction submission to OSC are a cover letter, the cost breakdown, and a holdover letter. This is a letter from the occupying agency to the landlord informing them of the agency's decision to exercise the holdover option while negotiations are ongoing. If this letter is available to submit with the holdover transaction, it helps with OSC's audit. For closeouts and drawdown transactions submitted electronically, the only document required for submission to OSC is a cover letter with information regarding the transaction. Next slide, please. What documents should be included with renewals? There are different types of renewals. A couple of examples are a fixed rate renewal and a to be determined rate renewal. When we say a fixed rate renewal, we mean that the rental rate for the renewal term was written into the lease and already approved. For this type of transaction, documents to include in your electronic submission are a cover letter. You would provide a cost breakdown for a fixed rate renewal transaction if there are expenses in addition to the rent paid directly to the landlord under the renewal period that are not predetermined amounts. A renewal letter signed by both parties, acknowledging the renewal option is being exercised. Unlike a to be determined rate renewal, a fixed rate renewal does not require AG approval because the rental rates are already included in the lease terms, where the AG and all other parties have signed their approval and acknowledgement. A to be determined rate renewal differs from a fixed rate renewal in that the rent amount for the renewal period is not predetermined and written into the original lease's renewal terms and must be negotiated between both parties. When the rental rate is being negotiated for the renewal period via a market study or an appraisal, this is an example of a to be determined rate renewal. For this type of renewal, items to include in your electronic submission are a cover letter, the amendment document signed by all parties. This document should state the agreed upon rent amount for the renewal period. AG approval is required for this type of renewal because the lease language is being modified. Your cost breakdown. Show how the transaction value adds up. And a cost justification is needed because the rental rate was not determined at the time the original lease was executed, when cost justification was initially provided. Therefore, we now require justification of the new negotiated rate for the renewal term to help provide clarity of why the new rates are fair and reasonable. A fixed rate renewal is where the rental rate for the renewal term was written into the lease and already approved. For this type of transaction, documents to include in your electronic submission are a cover letter, the cost breakdown. You would provide a cost breakdown for a fixed rate renewal transaction if there are expenses in addition to the rent paid directly to the landlord under the renewal period that are not predetermined amounts. And a renewal letter signed by both parties acknowledging the renewal option is being exercised. Unlike a to-be-determined rate renewal, a fixed rate renewal does not require AG approval because the rental rates are included already in the lease terms, where the AG and all other parties have signed their approval and acknowledgement. Next slide, please. What is the funds reservation policy? Funds reservation means to set aside or reserve all or a portion of an appropriation for payment of future expenses on a contract. Appropriations are reserved to ensure their availability for payment of specified expenses. Funds reservation is required through the end of the current fiscal year. While it's officially called funds reservation, OSC will sometimes refer to funds reservation as encumbrance in our correspondence to agencies. This is more out of habit. We are trying to retrain ourselves to use the term funds reservation to align our language with the GFO's language. So if you get an email from OSC regarding the lease's encumbrance, we are really talking about funds reservation. The state's fiscal year runs from April 1st to March 31st. SUNY and CUNY's fiscal year runs from July 1st to June 30th, and agencies that follow the federal fiscal year from October 1st to September 30th. You can find more information about what funds reservation is at the GFO link at the bottom of the slide. How do I calculate funds reservation for a lease? So here's an example of a 10-year lease, and in the table we have rent costs, electric costs, and operating expense costs for this lease. For the sake of this presentation, this lease follows the state's fiscal year. To calculate the funds reservation amount, we would take the monthly lease costs paid to the landlord and calculate how many months to pay these costs to the end of the current fiscal year. In this case, the lease starts on April 1st at the start of the fiscal year. The funds to encumber would be 12 months worth of lease costs for this lease. The transaction value for this lease would be $360,000. But the amount of funds to encumber on this lease is $36,000 because that is how much money is needed to ensure the landlord gets paid through the end of the fiscal year, and in this case, March 31st. And now Nicole's going to answer a few more of your lease questions. Thank you.
Thanks, Shelby. I'm Nicole McGuire, another one of the RPN team auditors, and I'm going to answer some more of the questions you guys sent in. Starting with, what should I include in my cover letter to OSC? The cover letter, or memo, is arguably one of the most helpful documents an agency can include with transactions sent into OSC. The most basic information we would like to see included in a cover letter is the lease number and property address, but so much useful information can be conveyed with this document. The cover letter is also the best place to include the agency contact information. This should be where we see the name, email address, and phone number of the primary contact. A lot of the time, what we see on this letter is just a signature or preparer's name, so having your contact information available really helps us get a hold of you if we have any questions about the contract package. The cover letter additionally can provide us with a summary of the intent of the transaction. A basic lease renewal may only require a few sentences to say just that's what it is. But, as we all know, lease transactions can get pretty complicated. Both the transaction value and intrinsic value can be outlined in the cover letter. OGS, for example, uses a format that includes the cost breakdown chart as part of the cover letter. They provide an outline of the first year's expenses, both on and off contract, and then a column for the full expenses for the entire lease duration. This is the most comprehensive introduction to us of what we should be verifying in the included lease documents. The cover letter can also include a summary of any circumstances that are not typical of a standard lease agreement. The best part about the cover letter is really that there's no limit to the information you can provide us with here. We understand not every space is the same, and the needs of every agency are also not cookie cutter. If the operating expenses include costs that are not typically found in a lease, the lease itself might not point us right to an explanation, but the cover letter would. Being able to tell us why this case is different up front may reduce the amount of time we spend on our review or the number of questions we have to ask to clarify these unusual circumstances. We've seen the full salary of a maintenance person rolled into operating expenses. While this is not typical of most leases, in this one case, based on the location and the needs of the agency, it was warranted. We did have to spend about a week trying to clarify this need with the agency. It wasn't typical for them either. So if these odd cases are documented along the way and then presented with the contract up front, it really just points us right to the answers of our questions without even having to stop and ask. Another question you guys asked was, how do I process a novation agreement? Novation agreements were formally referred to as contract assignments. They are formal agreements where one landlord transfers the rights, obligations, right to payment, and liabilities under a lease to another landlord during the original lease period. A novation may also occur due to an incorporated partnership or if a firm was purchased by another firm. Contract novation agreements require 2 transactions to be processed completely. The first transaction will be a closeout and a drawdown of the remaining funds for the existing lease. The only document required for the closeout portion is a transaction summary form, unless the transaction has come into us electronically. A memo can be included, but is not required. The closeout date should be the day prior to the novation effective date. This is the most common reason we have had to non-approve these closeouts. So if the novation is effective on, say, October 1st, the closeout should be dated September 30th. This, unfortunately, is a change we're not able to make in the system on our end, and as a result, it can hold up processing approval for both transactions because they're tied together and require simultaneous approval. The second transaction is the novation agreement to establish the new lease with the new landlord. This transaction requires an executed contract novation agreement containing the previous written consent of the agency, department, or official that awarded the contract, the Attorney General approval, and a current Appendix A. Additionally, the vendor responsibility profile, questionnaire, and insurance certifications for the new landlord should be included. The total value entered for the novation should mirror the amount being drawn down in the corresponding closeout. For example, if there's $2,000 remaining on the lease, the closeout should equal a negative $2,000, and the novation should be a positive $2,000. If there are any discrepancies, they should be clarified in, you guessed it, the cover letter or the memo that comes along with the transaction. And as previously stated, the effective date of the novation should be used as this new contract's begin date, and the end date should remain the same as the original lease agreement. We've added the section of the GFO to refer to for guidance on these transactions. Another question you guys asked was, what is a purchase order and when is it appropriate to use one? Purchase orders are transactions generally used for one-time purchases that exceed the OSC pre-approval threshold and do not require a formal contract document. The audit ID for these transactions will begin with an OP. The most common purpose for agencies to submit purchase order contracts to the RPN team is for any purchase that is lease related but not covered by the scope of the lease. These are payable to the landlord or a third-party vendor that will be completing the work. A purchase order should be submitted with a lease or in relation to an existing lease. An example of several purchase orders we saw this year were for COVID-related alterations. These expenses couldn't be included in a lease that started 5 years ago because COVID wasn't something we had to consider then. Some agencies opted to request a purchase order to renovate their restroom facilities to include several touchless features to cut back on shared germ surfaces. Some medical office leases added special cleaning sprays and disinfectants that were also not accounted for in the original cleaning expenses. These purchase orders were specifically requested by agencies to have a review completed by OSC because the work that was done was elective in order to take precautions. These were all standalone costs requested via purchase order. Other examples outside of COVID-related work that we see purchase orders for would be HVAC repairs, moving out expenses once a lease is complete, or even replacement light bulbs for a building space. The following documents are what should be sent in with a purchase order: a memo or cover letter stating the purpose or need for the work. If the vendor completing the work is not the landlord, the required vendor responsibility documents should be provided. We would want to see proposals, quotes, or invoices for any lease construction services, in addition to a fair and reasonable letter or proof of price reasonableness, which is an agency's facility unit review or third-party engineering review, and a cost breakdown for the requested amount. We've also added this section of the GFO to refer to for guidance in the future on these transactions. Another question that we received was, for real property leases, what should be included with the cost justification and the site selection process? So this question has two parts, but ultimately the cost justification and site selection are inextricably tied together. First, we can tackle what should be included with the cost justification. So the cost justification must show that the cost of the lease is fair and reasonable. The most concise way to provide this information is with a comparable market analysis. The market analysis will show a comparison of rent for the selected property versus the other considered properties. The cost justification should show a consideration of all costs considered and included in choosing the lease property, not only base rent. For example, if an agency is currently in a building and ready to begin a new lease, moving expenses might be required to relocate office space and furniture to any other property. Showing these expenses are above and beyond the costs required to stay put is just one way to establish why the current space is the best fit for the agency's or program area's needs. So many other expenses can factor into the total lease cost. Items like utilities, taxes, operating expenses, janitorial costs, they can all vary from location to location, and when factored into the overall cost of the lease, can ultimately determine which location is the most cost-effective for the agency's needs. Aside from cost, there are other factors to be considered in selecting the right lease space. A medical office lease might prefer to be located in close proximity to a hospital, and while it might cost more than comparable spaces, location may, in the end, justify the need to pay the higher rental rate. A motor vehicle office for public transactions will require a different kind of space than most of our cubicle-filled buildings. These are just the factors that could change the agency's site selection and the justification for that decision, and they should be included in the contract documents. This information can be included with the cost justification or can be outlined in the, you guessed it, cover letter sent with the contract package. And now I'll pass it over to Andrea to dig into all of the math questions that you've asked.
Thanks, Nicole. I'm Andrea Fabosi, and I'm also an auditor on the RPN team. And I'm going to talk about the math questions, including cost breakdowns, calculating transaction value, and intrinsic value. So one of your questions was, what costs or expenses are included in the transaction value? The short answer is that the SFS transaction value should include any payments made directly to the landlord over the transaction term. The transaction amount in SFS can only include payments made directly to the landlord. The contract is set up in SFS under the landlord's taxpayer identification number, or TIN, so that SFS transaction value can only be paid to that TIN. Of course, the lease will include rent payments to the landlord, but what about other costs, such as utilities, etc.? Let your lease be your guide. When in doubt, check your lease. The lease will tell you who is responsible for paying what to who. Another question that you had was, what is a cost breakdown and what should it include? The cost breakdown should be an itemized list of all the cost information over the term of the transaction, including anything paid directly to the landlord, any amount remaining on the contract to be subtracted from the transaction value, and any intrinsic value items. We'll talk more about intrinsic value a little bit later. Any funds remaining on the contract that are not needed must be subtracted from the transaction amount. If there are funds remaining that are needed for any purpose, such as rent, outstanding bills, or expected escalations, just tell us. The remaining funds need to be addressed because we'll see them when we do our audit, and then we'll have to ask you about them if we don't know why they've been left on the contract. To show us your calculation, you can use whatever method works for you. You can write it out in a cover letter, include a chart like this, or even upload an Excel spreadsheet. In this example of a lease holdover, the tenant is responsible for paying the landlord for rent, electric, tax, and operating escalations for this 12-month period. Because all the costs are paid directly to the landlord, they're all included in the transaction value. The total for all those expenses is $21,400, and in this case, there's also an amount remaining on the contract of $3,750, which, when subtracted, results in an SFS transaction amount of $17,650. What is the intrinsic value? How do I calculate it? And what does it include? The intrinsic value is the total value of the lease transaction, regardless of who's paid. So remember, the transaction value in SFS can only include payments made directly to the landlord's TIN. The intrinsic value includes the entire transaction value plus any other costs associated with the lease that are paid to other entities. The intrinsic value is important because it helps compare costs across generational leases. Nicole touched on that a little bit. So a replacement lease might have different terms that would make it harder to compare costs from lease to lease. The intrinsic value gives us the entire picture. The intrinsic value is also necessary for our processing purposes because our auditing approval authority for contracts is based on the intrinsic value. Basically, if you don't tell us the intrinsic value, we'll have to ask you for it, and that'll hold up our review and take us longer for us to improve your transaction. So help us help you. Some examples of costs that would be included in the intrinsic value, but not the transaction value, are any kind of utility or service payments that are made directly to the utility company or service provider. Here are some examples of calculating intrinsic value. These are for a replacement lease with the same landlord. All of these examples show the various costs that add up to the transaction value and intrinsic value for the new lease. In this lease, there will be payments to the landlord for rent and tax escalations. There will also be an estimated $50,000 in electric payments that are made to the local utility company. The utility payments are part of the intrinsic value, but not the transaction value because they're not paid to the landlord. When a new lease is replacing an old one, you might have to subtract the amount that was paid in holdover if the terms overlap. In the replacement lease example on the right, a new lease is replacing an old lease that was in holdover at the old lease rate. The new lease term overlaps the holdover term of the prior lease, and $700,000 was paid on the old lease during the overlapping period. The amount paid in holdover on the old lease must be credited to the new lease by subtracting it from the transaction value. Here's another example of a holdover calculation. In this example, telephone and electric charges are paid directly to the landlord and therefore are included in the transaction value. If they were paid directly to the utility companies, then they would be in the intrinsic value, but not the transaction value. Again, any amount remaining on the contract that is not needed to pay outstanding bills must be subtracted from the transaction value. If the funds remaining are needed for any purpose, just tell us, because there's no way for us to know what payments are supposed to be coming out of your lease. No one knows your lease better than you do. So help us help you. If you don't tell us, we'll have to ask, and that'll delay processing of your transaction. You also asked, how do we address changes in contract amounts over time? So leases often contain estimates for things like utility charges, operating, and tax escalations. These items can be over or underestimated, resulting in a surplus or shortage. In the case of overestimated costs resulting in a surplus, the excess remaining amount must be subtracted from the value of any new transaction. In the case of underestimated costs resulting in a shortage, the lease is going to run out of money before the term's over. So you'll have to send us a transaction to add money to the lease. You'll have to explain to us where the money went. This can be as simple as pointing out which costs were underestimated and including some documentation as proof. Documentation could be bills or invoices from the landlord that show, it was more than we thought it would be. As always, you have to include a cost breakdown for the entire transaction value. You also asked if remaining closed lease funds should be brought down, meaning down to zero. While there's no legal requirement for bringing down the lease funds, it's a best practice recommendation. So at the end of the lease's life, you should process a closeout transaction. First, you must verify that all outstanding payments under the lease have been made. This is important because once the transaction has been closed in SFS, no further payments can be processed. If any bills come in after closeout, they can only be paid on an OP contract or lease PO. The end date of the closeout transaction should be the end date of the contract, and the amount should be negative, equal to the amount remaining on the contract, so that it equals out to zero. Again, please include a cover letter to explain what the transaction's for. Now I'll turn it over to Jacqueline and Lindsay to address any additional questions you may have.
Hi, thanks Andrea and Nicole, Shelby, and Sarah for all of that. So I'm going to answer a couple of questions and then Jacqueline's going to answer a question and close everything out. So someone asked if the landlord is doing upgrade work to a facility and charging us for the upgrades, what documentation is needed. So in that case, you want to send a purchase order to us for review as long as it's over $50,000. And we would need invoices or vouchers documenting the expenses or an estimate, depending on what they're doing, a cost breakdown explaining all of that. And then you'd need a fair and reasonable letter from OGS, which leads to the next question, which is when is a fair and reasonable determination of cost required for upgrades to lease spaces required. So anytime we're doing upgrades and the total is over $50,000, we would need to see a fair and reasonable letter from OGS with your transaction. Those are the only two questions I'm going to answer for right now. I'm going to turn it over to Jacqueline.
Great. Thank you, Lindsay. And thank you, presenters, and thank you, attendees, for coming today. Okay, so we have one more question. How would an ovation closeout transaction be processed for a revenue lease if the future amount paid is undetermined as it is dependent upon numerous conditions? So the short answer is that a revenue lease novation should be processed in a manner similar to that of a regular lease. It'll just kind of be like the opposite, since money-wise, since it's a revenue, and you would still follow the same concepts with the dates. But the part about the amount gets a little bit trickier. I'm thinking that if you don't have the value known, it would have to be an estimate calculated based on those potential dependent conditions. It would be like your agency's best guess of what could what could happen. And then, as Nicole mentioned, a cover letter would be a great place to outline this unique circumstance and kind of justify why or how that estimated value was determined. I have a feeling that the person who sent this question has a certain contract in mind. So if that's the case, reach out to me, or I'll reach out to you and we can talk about that specific transaction. And then we've got another question: is a B1184 required for SUNY leases? So you need to follow your own procedures, right? If SUNY's procedures require a B1184 approval, then you should obtain that. And if it's something that's required, if B1184 approval is required by DOB, you should obtain that. Yeah, I thank you all for coming, taking time out of your day to join us. We hope you found this helpful. And again, please do not hesitate to reach out to us for any questions that you might have, and we will do our best to help you out. Thank you, everybody.